And I do think that level of information overload gives people a lot of illusion of control. I don't want to go into this deeply because I know you'd like to get me going on this, but I think the meme stock examples, I don't think they're the norm by any means, but I think they're the ultimate example of a little bit of information making you think you really know something very deeply, and I think that gets into market prices.
I'll be careful to keep this a little reined in, but on the meme stock issue...
I knew I'd get that started.
Hello investors, and today we're diving into the mind of Cliff Asness, the quant wizard behind AQR Capital Management. Now, before you roll your eyes thinking, oh great, another finance guru, hear me out. Asness studied under Eugene Fama, the godfather of efficient markets hypothesis, and has been managing billions for over 3 decades. So whether you're a die-hard stock picker or a passive index devotee, buckle up. Cliff's about to drop some truth bombs that might just make you rethink everything you thought you knew about markets. So first of all, Cliff Asness, the man who practically breathes efficient market theory, thinks markets are less efficient now than 30 years ago. I know, it's like hearing Santa isn't real all over again. But Asness defines efficiency as prices accurately reflecting fundamentals. But here's the kicker. He believes prices have become more disconnected from reality over time. Why? Well, grab your popcorn, because this story got more twists than a hedge fund's fee structure. Cliff points out, we've seen both the severity and the duration of those extreme valuations. He is talking about the dot-com bubble, which was crazy enough, but recent years have seen even wilder valuations lasting twice as long. It's like the market's been binge-watching its own drama series. Usual suspects, why markets are less efficient, so who's to blame for this market's madness? Asness, in his infinite wisdom, points to 3 culprits. First of all, the internet and social media. Plot twist, more information doesn't always lead to better decisions. Shocker, right? He compares it to the wisdom of crowds, but warns a crowd where everyone is coordinated and not independent has the risk of becoming a dangerous mob. In other words, Twitter isn't exactly the Oracle of Delphi. Second, the rise of passive investing index funds might be playing a role, but Asness isn't ready to throw them under the bus just yet. It's like that friend who might be a bad influence, but you're not quite sure. And third, ultra-low interest rates, which low interest rates have pushed investors into riskier assets. It's like everyone decided to take up skydiving at the same time. Third, like meme stocks, the class clowns of finance. Remember GameStop's wild ride? Asness sees meme stocks as a poster child for market efficiency, but not the main villain. They're like that one kid in class who gets all the attention for being disruptive, but isn't actually causing the real problems. Cliff notes, I think they are kind of the poster child. I don't think economically they are that important. 4. Bubble trouble. Not quite. Good news. Panic-prone investors who are not in full bubble territory anymore. Asness, ever the optimist, explains, right now at the 80th percentile. Yeah, you want this as part of your portfolio. Maybe you want a little more than normal, but it's not the opportunity of a lifetime. Translation, the party is not over, but maybe switch to light beer. 5. Value investing. The comeback kid. Value investing isn't dead, but it's definitely being through rehab. Asness has downgraded value investing, which is like saying your favorite band's new album is pretty good. He muses, we do think it's more attractive than normal, but it's not an arbitrage you can drive a truck through, so maybe a smart car then. 6. Evolve or die. How AQR stays ahead. Asness shares how AQR has upped its game. First of all, more systematic allocation among equity factors. Fancy speak for letting the machines decide. expanded into the new markets and commodities. Apparently, Malaysian palm oil is the new black. Improved trend following strategies, because following trends never goes out of style. Cliff boasts, we've taken a huge leap, tremendous exposure to more esoteric trends. Watch out, World AQR might start trading unicorn futures next. So what is conclusion here? This short video. So what pearls of wisdom can we mere mortals glean from the great Cliff Asness? First of all, markets aren't perfectly efficient. There is a hope for us stock pickers yet. Second, be wary of information overload and social media hype. Your cousin's hot stock tip probably isn't the next Amazon, sad to say. 3. Value investing still has merit, but don't expect miracles. 4. Diversification is key. Maybe it's time to add some Malaysian palm oil to your portfolio. 5. Stay adaptable for sure. If the quant kings like AQR are evolving, you probably should too. Remember, investing is a marathon, not a sprint. Unless you're day trading meme stocks, then it's more like a chaotic obstacle course. So my dream is to create my own hedge fund one day. Yeah, because the world clearly needs another one. So I keep learning from the best investors and some mediocre ones also, and invite you to join me. I'm here to squeeze all the juicy bits of info into bite-sized pieces so you don't have to waste your precious time. Check out my results as a portfolio manager right here. Feel free to drop your brutally honest feedback about this video and others in the comments below, please. That's a lot for today, folks. If you enjoyed this short journey into the mind of but still very valuable Cliff Asness, smash that like button and subscribe for more investing insights, served with a side of snark. Until next time, may your returns be high and your fees be low.